And now our top line story. All of a sudden, investors are asking themselves, what has happened to the Trump bump? The S&P 500 has fallen steeply during the second half of February, so steeply that it is now trading at less than the closing value on November the 6th last year. That, of course, was the day after Donald Trump's big election win and the beginning of a rally based largely on investors' hopes for lower taxes, less regulation, and a pro-growth policy agenda in Washington. Now markets are worried about Trump's tariff vows and whether they will fuel a resurgence in U.S. inflation. Let's talk about it further with our featured guest of the morning. Lenka Martinek is managing partner at Sustainable Market Strategies and Nordis Capital, and she joins us this morning from Montreal. Lenka, first of all, welcome to the show. Great to have you back with us. What is your take on the tone of U.S. markets during the second half of February, when that index has plunged from a record high to a level now that has almost wiped out all of the rally since Donald Trump was elected?
Yeah, hi, Paul. So let's start by stating the obvious. Financial markets do not like uncertainty. And so I think if we sort of look at what has happened over the last couple of months, what we know from Trump's presidential style is it's something that inherently creates uncertainty. And so this is basically the worst sort of backdrop that we can have from a sort of financial market perspective. If you don't mind, I'd like to just talk about two things where we think this uncertainty or where this presidential style is coming from. We hear a lot about, the first one is this flood the zone. So this idea that Trump is really trying to create an environment of information overload. And of course, what you're trying to do for domestic consumption is obviously not the same thing that markets need. And so this, a lot of this information becomes distracting to market participants and creating this uncertain environment. And then the other thing that I want to say, the second part about the style is actually from, I think we can take a look at sort of the business crisis management textbooks, this sort of idea that it's better to be fast and wrong rather than slow and right. And so we see this kind of unfolding with sort of the Department of Government Efficiency, particularly with Elon Musk. We fire a bunch of people, we cut back budgets, we get it wrong, and then we bring them back. And so this sort of start-stop attitude is, again, something that is inherently at odds with what markets like. So that's kind of point number one. The second one that I think is fairly important to recognize as well is that the other thing that corresponded with Trump's win in November was the peaking in the economic surprise index. So for viewers that are not familiar with that index, it's this idea that economics data comes in either ahead or below of market expectations. And so we were in a really nice uptrend in positive economic surprises up until November, but that index actually rolled over around the time that Trump was elected. Nothing to do with the Trump election, but basically the economic data started to come in worse than expected, which is actually is a true, I would say, indicator of a true sort of headwind to the U.S. economic cycle, which is obviously producing effects on stock prices as well. So there's the Trump element, but I think we can't also lose sight of the fact that there are some changes in the underlying economic cycle in the U.S.
What about the issue of tariffs and inflation? It's been very, very common for market watchers to say Trump's tariff threats are at bottom. They are a negotiating strategy, and that we are very unlikely to see 25% tariffs imposed either at all or for any significant amount of time. Now he has pledged that those tariffs are coming just days from now. Are markets less confident in this narrative of tariff threats being simply a negotiating tactic, and more worried about tariffs actually being put on for a lengthy period of time and fueling a continental or global trade war with inflation rising as well?
Yeah, so actually, Paul, I don't know if you remember, but we had this conversation in January. You asked me a very similar question in January, and my response at the time was we should absolutely be worried about tariffs. And I go back to this idea about, better to be fast and wrong than slow than right. And I think that is a very common what we're seeing with Trump policy in general. And so if you apply that to the tariff environment, what I think is a reasonable roadmap to expect is that we're going to shoot from the hip, we're going to apply some level of tariffs to everything, and then we're going to figure out who it really hurts, and we're going to pull back. So the way that I sort of see this, I don't know if the number is 25% or what exactly, but I think the direction of travel is we will see some form of tariffs. Something will happen next week. Hopefully that forecast pans out. But I think the more important thing here is that as there is economic pain in certain important sectors in the U.S., we will see a peel back of those tariffs. So one area, for one, that is quite obvious to us, if we take fertilizer as an example, potash, Nutrien, the company out of Saskatchewan, we produce so much of the U.S.'s fertilizer, about 25% of all fertilizer and like 90% of potash. This is basically the U.S. shooting themselves in the foot, as far as we can tell, for lack of a better expression. And so this is the type of area where you'd see, okay, we see this blanket tariff, and then we have a carve-out that's in place once we realize that we're actually really hurting the agricultural industry in the U.S. So I think it's a one step forward, one step back kind of approach, but I think it would be wrong for investors not to calculate some sort of tariff threat in their portfolios going forward over the next 6 to 12 months.
That's Lenka Martinek on our top story this morning. The S&P